Hello traders, and welcome to lesson number 7 in the ReadFX Beginners Forex Trading course. In this lesson then, we're going to answer the question, what is margin and leverage? Now, in the previous lesson, we looked at lots and contracts, and I explained that contracts are units of base currency, which means that it's possible to trade $100,000 or euros or pounds, etc. And you're probably wondering, who is trading such massive amounts of money? And you might be surprised to learn that the answer is you. Now, that's because of something called leverage. So leverage allows you to control more money than you actually have in your account. What is leverage then? So leverage is provided by your broker as a function of your trading account. It allows you to magnify gains and losses. You can think of leverage as a loan from your broker. So if you give you an example, if you have $1,000 in your trading account with leverage at 1 to 100, you can actually control $100,000 with your $1,000 account. Now that's potentially quite dangerous, so for that reason leverage is quite tightly controlled. Leverage is restricted by financial regulators, and some are more strict than others, and the regulations also change over time. A few years ago you could easily get 1 to 500 leverage at most brokers, but now you'll find it's restricted to 1 to 30 in the UK, Europe and Australia. So in the US it works a little bit differently. Leverage is restricted to 1 to 50 for the major Forex pairs and 1 to 20 for the other pairs. But there's always a loophole. So regardless of where you live, you can easily get 1 to 500 leverage or even higher by using an offshore broker. Now, these brokers are registered with regulators that have a more relaxed attitude, and some are registered in places where the only rule is that there are no rules. They're generally on some tiny little tropical island that you've never heard of. So let's have a look at margin. So margin and leverage are two sides of the same coin. Leverage is the amount that you can borrow from your broker, and margin is the amount of capital required to secure that loan. It's a bit like when you get a mortgage. Your mortgage is your loan and you have to put down a deposit to get that loan. It's a similar sort of deal. So if your account is leveraged at 1 to 100, then your margin requirement is 1% because that's 1/100th of the amount you want to trade. So if we look at an example, you buy $100,000 with your $1,000 account leveraged at 1 to 100. Your margin requirement then to open that trade is 1% of 100,000, which is $1,000. Now, this describes initial margin or used margin. So this is the amount required to actually get the trade open, but we have an additional margin requirement as well, and that's known as maintenance margin, and this is displayed on your trading terminal as margin level. Now, this is an amount of money that you must have available in your account to keep the trade open. Margin level is shown as a percentage based on the following calculation. So margin level equals the equity of your account divided by the used margin, so that's the amount required to open the trade, multiplied by 100 to turn it into a percentage. So if we have a look at an example, let's imagine you have a $10,000 account and you have one open trade. Your margin requirement to open that trade was $2,500. So initial margin or used margin is $2,500. The margin level is $10,000. So your account balance or account equity in this case, we're ignoring the fact that the trade is open. It could be positive or negative. So the margin level is account equity divided by the used margin times 100 equals 400%. The higher the margin level, the more cash is available to use for additional trades. Now, if the margin level drops to 100%, that means all available margin is in use and no more trades can be placed. So if we look at the example above where your margin level was 400%, that means there's still some money left in the account to open additional trades. But if it drops down to this level, you don't have any money left to put down as a deposit to borrow money from the broker to open additional trades. Now, that was a simple example. In the real world, this is what it's actually going to look like. This is what you're going to see on your account. So this is a screenshot of my phone. And what we'll do is we'll just go through this real life example. Let's have a look at margin level. And so margin level, as we know from the previous slide, is equity divided by use margin times 100. In this case then, equity is our account balance plus the floating profit. Now this can be positive or negative. In this case, I have some open trades. Some are winning, some are losing. And the sum of those trades added together, obviously there's more trades that you can't see, is minus £23.66. So if we take my account balance, 110,000, minus my floating trades, this is my equity. And now that we know the equity, we can do this calculation. So margin level then equals my equity, which is this number here, divided by £20.49. So that's come from the margin. This is the amount that the broker has asked me to put down to open these trades. So this is our initial margin or used margin. So in order for me to open these trades, I have to have at least £20.49 in the account. And obviously you can see I've got quite a bit more than that. So account equity divided by the margin requirement from the broker, my initial margin or used margin, times 100 equals this massive number here as a percentage. And that's what we see in this section as the margin level. And the free margin then is equity minus use margin. So equity, this number here, minus the use margin equals the free margin. So this is all very, very simple, but you'd be surprised how many traders don't know what these actually mean. If you don't understand margin, you're going to get into a lot of trouble in trading. There are calculators and various tools you can use to make sure that you always have enough margin to keep your trades open. Now, my website has a margin calculator. I'm going to go over there now and have a quick look at it. Okay, so we're on the ReadFX homepage and I'm going to go to the top and click on Forex calculators. Now this time I'm going to scroll down and select the margin calculator. And you can see we're using Euro US dollar, which has been the example throughout this course. And we currently have 100,000 units, which is one lot. Now you'll remember that I said that in the UK, Australia and Europe, leverage is currently set to 30 to 1. So if we click on calculate, you can see that we need $3,500 US to open a one lot trade. So we have 100,000 contracts. If I just switch it to lots, you see this is a one lot trade. Now, if I increase this to 500 to 1, which is the most common leverage available at offshore brokers, we can now see that instead of $3,500, we only need $210 to open that exact same size trade. So having access to a higher leverage allows you to control the same amount of money with a lot less money deposited in your account. Now let's have a look at what happens when you run out of margin. So you get what's called a margin call. Now if your margin level drops to 80% at most brokers, you'll be asked to deposit more money to cover your position. So what basically happens is your MT5 terminal, for example, the bottom part will flash red. You'll get an email from your broker. You might even get a phone call to ask you to put more money in. And that's usually at around the 80% level. This differs quite a bit. Most brokers it's 80%. I have seen it at 70, some it's at 100. It just depends on the broker and where they're regulated. Now, if you fail to put money in or take action to increase your margin, i.e. by closing trades, for example, it goes to the next level. And the next level is what's called a stop out. So if your margin level drops to 50% at most brokers, the broker will begin to close your trades and you will lose money. Now, as I said, these levels vary depending on the broker, the regulator, and the instrument being traded. You tend to find that Forex has the best trading conditions in terms of margin and leverage, and then things like stocks or indexes or commodities have lower leverage and higher margin requirements. But it's important that you always know your limits, because you don't want to take a completely unnecessary loss because you entered a trade at a large position without checking to see if you had enough margin in your account. In this lesson, we covered margin and leverage, we looked at a margin calculator, and then we explored margin calls and stop out. In the next lesson then, we're going to look at trading sessions.